Figma just became a public company and it's currently trading at 107 times sales. To put it simply, this is astronomical. But before you dismiss it or think that the company is overly hyped, there are 5 key metrics that tell a different story. Let me break them down for you in this video, and then you can decide whether or not this design platform justifies its premium valuation. First, the company fundamentals are exceptional. In the most recent fiscal year, the company generated around $749 million in revenue, up from $504 million in 2023, which represents a 48% year-over-year growth. But what's even more impressive is that the company during this period had 132% net revenue retention. This means that existing customers are expanding their usage and how much they're paying the company by 32% annually without any new customer acquisition. In a market that is projected to grow at 15% per year, this is remarkable expansion. Add to this a 91% gross margin and you have the textbook SaaS economics that everybody loves. But the valuation tells us that the market expects this high growth to continue indefinitely. Customer retention above 95% suggests that this isn't just about software, it's infrastructure. In fact, what we see over and over for large enterprise clients is that once a team adopts Figma's collaborative workflow tools, the switching costs to go from Figma to another solution become very prohibitive. And the reason why is because the product enables real-time design collaboration that was impossible before and makes it so that multiple designers, developers, and stakeholders can work in the same project or the same file simultaneously. And of course, this creates powerful network effects where the more people in the organization that are using Figma, the more valuable it becomes to the organization. This is a genuine competitive moat. But here's the biggest risks that nobody's talking about, and this is that AI design tools such as DALL, such as Lovable, even tools such as Cursor, they allow companies and individuals to code entire applications from simple text prompts. And this brings up a question: if AI can create designs directly, does the world really need a collaborative design platform? This is the existential question for Figma's future and something that the CEO mentioned in the company's filings. The counter argument to this is that complex enterprise design requires human collaboration, iteration, and stakeholder input. And this is because some of these other tools can start to generate designs, but they can quickly become generic and lose some of their value. And while AI might handle simple projects very fast, Figma is positioned to dominate complex workflows. Now, 107 times sales only makes sense if Figma maintains hyper growth. But there's a more immediate concern, and this is that in January 27, 2026, the company's lockup period expires, where insiders, early investors, and employees are able to finally sell their shares. This is something that can bring potential selling pressure on a company that's already very high priced. And on top of this, if the growth of the company slows down to 20 to 30% annually, which is still excellent for most companies, the valuation can become impossibly to justify, leading to a lower stock price. So in my price prediction, I have 30% projected revenue growth for the company within the next 5 years, which is an aggressive number but reasonable given the company's history of growth and the company's net retention rate. On top of that, I have a terminal price to sales ratio of 15. If you look at some of the comps that I have right here, and by the way, this is all data, as you can see, that comes directly from the Wisesheets add-on, so I highly recommend that you check it out to support the channel, and also most importantly to make your investing as simple and powerful as it's ever been. But anyways, as you can see, this actually makes sense given the projected inputs of the company. Now moving back, I have a discount rate of 12%. We can also make this higher given that the company does have quite a bit of risk involved, given that it's a brand new public company and it doesn't have a long history of operating successfully in the market. But with a 12% discount rate, you can see that the price per share of the company is around $24 per share. Right now, using this formula from Wisesheets, you can see that the company is trading for $86 per share. So this represents a downside percentage of 71%. So here's my take. Figma is definitely an exceptional business, trading at a very high price, unfortunately. The fundamentals are great. So 132% net retention, 91% margins. Obviously, they're in a dominant market position right now, and this is quite impressive, but you are paying for perfect execution. So this is something very important to keep in mind. And if you believe that collaborative design tools like Figma will dominate the future of AI, and AI won't be disrupting the existing workflows that customers are following to take advantage of tools like Figma, then this could perhaps justify the company's valuation, especially if they're able to execute really well within the next couple years. But with the lockup expiring in early 2026 and AI tools advancing rapidly, this is a play that, it could be high reward, but there's also a high level of risk involved. So my move is to wait for now, look at the company's quarterly results, and then wait to see what kind of effect the lockup expiring will have on the company's stock price. And if you want to play around with my price prediction spreadsheet, be sure to check out the link in the description where you can download it for absolutely free. Only thing to note, of course, is that you do need a Wisesheets account if you want to get the data automatically, but if you want to enter it manually, then you won't have any issues. Let me know in the comments what you're doing about the Figma IPO, and I'll see you in the next one.